What actually classifies as recession? Let's get into it. Is it GDP, unemployment, business activity, or the stock market? In general, a recession is a period in the economy of slowing economic growth to the degree that it impacts consumer spending, the stock market, employment, and business activity. Let's start with spending. Spending drives the economy, and that's measured by GDP. When you get negative GDP for 2 quarters in a row, that's considered to be a period of recession. Business activity is measured by the ISM PMI survey, and when it drops below 50, that's considered recessionary territory. Unemployment is the most popular measure of the labor market, and when it gets above 5%, that's considered recession territory. But it's not just about the 5% level, it's about the speed at which unemployment rises above 5%. The stock market is a measure of financial conditions, and when it drops somewhere between 20 and 25%, that's considered recession territory. So how are these 4 categories tied together? Consumers spend less, businesses slow, profits drop, hiring stops, unemployment rises, and stock prices move lower. But actually, stock prices move lower before a recession takes place because investors are tracking consumer behaviors and business activity to foresee where the economy might be headed. If the data is trending towards recession, investors will sell their stocks before it happens. This makes the stock market a barometer of future expectations because it prices in uncertainty well before the final data rolls in. The unemployment rate is such an important factor for 2 main reasons. For one, the less people employed, the less money they make, and the less money they spend. And remember, the economy is driven by spending. For 2, the higher the unemployment rate, the weaker the labor market, which means the lower productivity. When productivity drops, supply chains can get backed up. If supply chains get backed up, prices can rise, further turning off consumers from spending. When business activity goes negative, it reflects a negative return on every dollar invested in the activities of business. Activities include supply chains, logistics, manufacturing, construction, labor costs, or service fees. GDP growth isn't about the net total of spending. It's about the growth rate of spending versus the growth rate of debt. Just because the growth rate of GDP goes negative doesn't mean the growth rate of debt goes negative, which means debt burdens become larger, further crippling economic growth. Thanks for watching this video on how recessions are classified. I hope you learned something. Don't forget to like and subscribe for more content like this.